Hi, Jessica. How
Hello.
are you doing today?
I'm good. How are you?
Well, I'm inside on a day like today, but that's all right.
Yeah, well, I've been inside too. I had to do another midterm presentation today, so
Oh, yeah?
I've already had a long day. I have a few assignments for you. When was the last day we can turn in stuff?
Basically, yeah, I'm going to talk about that tonight. It'll be next Tuesday. So the test was postponed from today to next Tuesday since we didn't have class last week. So, yeah, it'll be next Tuesday.
Yay. Okay. All right, good.
And I did do some grading today, so if you log into Canvas, you should find a few of your things graded. Because you submitted a few things, at least I know.
Yeah. Yeah, the textbook extra credit, was that counted for on my grades yet?
It should have been. Let me log.
Okay. I just noticed on Canvas like a couple weeks ago that it wasn't.
Oh, okay. Yeah,
It was,
I thought I got everybody written down, but let me check.
it just might really help me.
Every point counts.
It does.
Yeah, it's on there, Jessica.
Okay, thank you.
Hi, Austin.
I see you're checking in.
Good to see you. And is that Helen? Here, I'll unmute you. There you go.
Yes, that's me.
Okay, great. Hi.
Hi. I'm going to email you about why I wasn't in class before,
Okay.
just so you know. Yeah.
Okay.
But I'm doing some catch up right now. I'm trying to get the work done, but I still haven't gone through the NNI yet.
Okay. All right.
I'm going to work on that tomorrow.
Okay. Yeah, I'm going to talk a little bit about submitting late homework because our first test is next week, and so. But I'll talk about that when everybody gets logged in. So. Hey, Marcus.
How's it going?
Good. How are you doing today?
All right, man.
Yeah.
Yep.
Yeah, I feel good that I at least got outside for part of the day today. I'm not sitting inside all day long. Beautiful day.
Yeah, that's how it's been pretty much all week.
Yeah.
Inside, you want to be outside.
I think it's supposed to get even hotter the next few days over here, like in the low 80s maybe. see what it says. Yeah, Friday, or yeah, I guess by Friday it's supposed to get to 80, high of 81. So we'll see.
Yeah, that's hot for Washingtonians.
Yeah, at least on this side of the state. Hi, Melissa. Let's see. I'm going to give folks a couple more minutes to log in, and then I'm going to go over what we're going to do tonight and the schedule for the next week. So, and oh, I guess I'll say while we're waiting for folks. So I have met with a couple people in the class over the last week about the Chapter 3 assignment, those problems. And they're not easy problems, first of all. So if you're struggling, that's expected. And two, and I think I said this in class 2 weeks ago when we last met, you definitely, for each one of those problems, want to create whatever financial statement is being asked about. Like I think the first one, 3.3, they ask some information from the income statement. So basically you want to create a really basic income statement using the information that they give you, and you end up having to work backwards through the income statement to find the missing information. I think they ask about, in 3.3, they ask about depreciation and amortization, and they give you like 3 other items or pieces of information from the income statement that you can use, but you have to work from the bottom up, essentially. So you have to start with net income and work backwards to get the answer to 3.3. And the same is true for the other 3 problems. They're really, it's the problems are like you're finding a missing piece of information. They're giving you everything but one thing, and so you have to go back in and sort of calculate things backwards to find out what the missing piece of information is. And I like these problems, one, because they really test your understanding of each of the statements and how they're calculated, how you get to the bottom line by making you go backwards through them. And two, just because they're challenging, and so they really force you to work backwards through them and really understand the financial statements forwards and backwards. So we're going to be doing more. We're going to be moving in Chapter 4 tonight, and there will definitely be more. This is where we start cranking out the math, but the calculations we're going to be doing are not. It's not like complex mathematics. It's basically we're going to be doing ratios, comparing different things from the financial statement, different figures as a way to measure business performance. So anyways, if you were having problems with those problems from Chapter 3, you're not alone. So just try to work through them. And as I said, build a small financial statement, whether it's the income statement or the balance sheet or the cash flow statement, and then work your way back through them. And in Chapter 3, we sort of went through the examples of the financial statements that they have in that chapter. If you're struggling understanding any of those financial statements and want to understand them better, those are great examples of the financial statements, especially the cash flow statement. It literally has a line-by-line description of what each of those items is in the cash flow statement. So I really highly encourage you to use those resources from the book. So, okay. So I know that Candace and Carolee are traveling today, so they won't be with us. Who are we missing? I guess we're just missing Drea and Deanna. Okay. So as I said, what we're going to be doing tonight is we're going to be moving into Chapter 4 and start. Chapter 4 is all about, it's the beginning of our work with financial ratio calculations as a way to understand how well a business is performing. And we use the financial statements to do that. So we're going to work through 10 different financial ratios tonight, and those will be, there are more than 10 in chapter, more than 10 ratios that they cover in chapter 4, but we're only going to be focusing on these 10. So you don't have to know all of those ratios in chapter 4. So we're going to be doing that tonight. A couple other things. One, I wanted to check in. I believe everyone is now set up with the nation-owned enterprises module with NNI. Is anyone not set up with that yet? Okay. Silence means no. If you're having problems, I know that one student was having problems where the video was sort of glitching out. Two things that you want to make sure that you do with your computer is to make sure that you're not using Internet Explorer. That's the one internet browser that does not work well with this module. So if you use Firefox or you use Google Chrome or really anything else in Internet Explorer, your experience with NNI should be good. If it's not, for some reason, the other item that they suggested checking was it uses a program on your computer called Adobe Flash to display these videos. And so, and in fact, I think I emailed this note to you all from NNI, but I'll do it again just in case. They have a link to where you can go to download the latest version of Adobe Flash. So if something's going on with your video, I'd recommend going to the website and updating your software. So, and I will make a note to email that to everyone so you have it. Okay. So this next week, originally I had intended for the first test to be today, but because I was not able to be, I was traveling last week, I was in Eastern Washington, and I thought I might be able to teach from where I was going to be, but I was actually on the road during class time. So I'm pushing the test back to next week. So test number 1 will be next week, and essentially we'll cover everything we've done in class, and that's mainly chapters 1 through 4. The video on the Member to Nation that I assigned, the writing assignment for tonight that was due tonight, that is due tonight. And then the NNI, the nation-owned enterprises information up through quiz number 2. So that was the last assignment in NNI, was for you to get to quiz number 2. And I don't know what exact slide that's on. It's probably on 25 through 28 or something like that. So those will be the 3 topics that'll be on the test next week. And it'll be open book, open note test. It will be time limited though, and I know that there have been students in the past who have had issues completing the in-class portion in time. And there will be calculations from chapter 4 on the test next week for sure. And so I would highly recommend, one, doing the homework that's assigned from chapter 4 prior to the test next week, just for practice. And to make sure that you have good notes on all of the financial calculations that we'll be doing, so that you can refer to them quickly, so that you don't feel time crunched. Typically, there are roughly 20 questions on the test, and you'll have almost the full 2 hours, aside from maybe the first 10 minutes of introductory stuff, to work on it in class next week. So you should have enough time to do it, but I highly recommend that you have your notes sort of organized and ready to go, and especially with regards to these financial calculations. So, but the only things that'll be on the test are the things we've discussed in class and covered in the book. There are a number of things in the chapters that we've read and that I've assigned that I haven't talked about in class. You're not going to be responsible for any of that, so don't feel like you need to know the entire chapter. So there will be that in-class portion, and then there's a take-home essay that I will publish on Canvas probably during the test next week while you're taking it, and it'll be due the next day by 7 p.m. So you have basically 24 hours to complete that. And it's an essay. It's just it'll be a 1-question essay. So, and I'll have information on that on Canvas next week. So that's the test for next week. The other thing, given that we're right around the midpoint in the quarter, is that any late homework, aside from the things that are due next Tuesday, needs to be turned in by 5 p.m. next Tuesday for test time to get any credit. I've graded some things so far, and you notice if you turn it in late, you may have a 10-point deduction or a 5-point deduction for lateness on the assignments. So you still get credit for turning them in late, not full credit, but you still get credit. However, after next Tuesday, you won't be able to get credit for anything in the first half of the quarter anymore. And so it's sort of the reset point is what happens. And really the reason that I do that is because if you're working on homework that was due 4 weeks ago, well, one of the things, it's intended to be practice for you, so that it's one more opportunity for you to practice using this information prior to the test. And if you haven't done it prior to the test, then it's not going to help you that much on the test. So yeah, so it's really just another way to encourage you to get that done prior to the test, so that you practice and then hopefully do well on the test also. So all late homework assigned that was due through today will be due by next Tuesday for credit, class time next Tuesday. I think that is it as far as updates go. Anybody have any questions about the test, about homework submissions, anything else? All right. Let's, there are no questions, and let's launch into chapter 4. So I'd recommend that everybody log into Canvas, because there's a worksheet there that I'm actually going to have you use as we go through these financial ratios. And so what I'm going to do tonight is we're going to go through these ratios one at a time. I'm going to explain them, sort of what they mean, how to calculate them, show you based on an example or information in the book, how to calculate a ratio. And then I'm going to have you calculate a ratio based on some other information in the book. And so the financial statements that we're going to be using to do these calculations are tables 3.1 and 3.2. So basically we need an income statement and we need a balance sheet to do these financial calculations. And so in the test, for instance, you'll be provided a spreadsheet that has an income statement and a balance sheet in it. And that's the information on those two financial statements in the spreadsheet is what you'll use to calculate the answers for the test. And there will be a homework assignment in exactly the same format where you're provided, let's see, yeah, it's the Hagen's financial statement. If you upload that file, that will provide you the financial statements that you'll need to do those financial calculations. So, so if you go to week 5, and hopefully you all can see that, and you can either access tables 3.1 and 3.2 in your book or via Canvas, that's fine. I'm going to be using, so they provide you with financial statements for both 2011 and 2010. So I'm going to use the information from 2010 to provide the example calculation for these ratios. And then after I've explained that and answered any questions, then I'm going to ask you guys to calculate the same ratio using numbers from 2011. So hopefully, again, this is just a way for you to see it and then do it. Hear it, see it, and do it. So let me, and what we're going to be using to show these calculations and this is the same document that you'll use to submit your homework, It's called Financial Calculations Worksheet. It's under week 5. So if you open that up and open it up in Word, you're going to want to be able to use it in Word and not just look at it in Canvas. This is where, these are the 10 ratios that I'll be covering tonight and that you'll be responsible for knowing. All right. Okay, so I'm going to share my screen here. You can all see this. Okay, so this is the financial calculations worksheet that you will use for your homework for next week, and what we're going to use tonight to talk about these different financial calculations. Before we get into that, though, just a couple things about these ratios that we're going to be calculating. In addition to knowing how to calculate them, you sort of need to understand what they mean. You need to understand whether a bigger number is better or a smaller number is better for each calculation. So you want to know what's desirable. And really, the way these are typically used by, say, financial analysts and other people, or even internal management in an organization, they'll use these ratios to compare one company to either another company, maybe a competitor, to see how they compare with their performance, or oftentimes a company will use these ratios to compare themselves to an average of different companies, maybe in the same industry. So Microsoft might use one of these ratios to compare themselves to all the other software-related technology companies to see how they're performing. And another way that they can be used is to compare a company to a benchmark set of companies. Does anybody know, can anybody tell me what a benchmark is as compared to an average? No ideas? So a benchmark is essentially a set of companies that's the highest performers in that industry. So a company, if they want to really perform well and excel and maybe lead the industry or dominate their industry, they want to compare their financial performance to the top performers in their industry, and those are benchmark companies. If they're just concerned about, say, being better than average, then they might compare their financial results against the average of every company, both the high performers and the low performers in their industry. So the main difference between average and benchmark is the benchmark are the top companies in a particular industry. So that's what I mean when I'm talking about comparing to a benchmark versus an average. And so those are the ways that companies use these financial ratios to sort of see how they are in comparison to other groups of companies, benchmarks or averages. So that's my preface to how they're used, and now we'll get into how we calculate them and what they are. So these financial ratios or calculations are sort of broken down into groups, and the first two financial ratios, the current ratio and the quick ratio, are called liquidity ratios. What does liquidity mean in a financial sense? We talked about this when we were talking about current assets and long-term assets, current liabilities and non-current liabilities. Melissa, do you have any idea can you tell us what liquidity means in the financial sense? Melissa?
Hi.
Hi. Can you help us out with liquidity? What does liquidity mean?
What?
Liquidity. Do you know what that term means in a financial sense?
No.
No.
I don't have a real skill for remembering math stuff.
Oh, okay. So basically liquidity is like I said, I talked about it 2 weeks ago, I guess, in regards to assets and liabilities on the balance sheet. Liquidity just means how fast can you turn something into cash. So how fast can you turn an asset like accounts receivable or inventories or even supplies into cash? So it's a measure of the ability of a company to raise cash from their own assets, essentially. And so these first two ratios here, the current ratio and the quick ratio, are ways to measure that. Let's start with the current ratio. And so the equation here for the current ratio is pretty simple. It's current assets divided by current liabilities. That's the equation. So this is how most of these ratios are going to be. We're going to be comparing one number on a financial statement to another number on a financial statement. So of these two, where are we going to find, Melissa, where are we going to find these two numbers? Are we going to find it on a income statement, balance sheet, statement of cash flows?
Cash flow.
Nope, balance sheet actually. These will be on the balance sheet.
I had it on my cash flow sheet, or what? It was a balance sheet, right? And I put that on there.
Yeah.
I don't know the names of the sheet.
No, that's all right. That's all right.
I can do the math and stuff when it's sitting out in front of me and I can follow the steps, but if you're asking me to remember terms, it doesn't work.
Well, that's all right because it's going to be an open book, open note test. So, and mainly because that's how we work in the real world anyway. So, but I'm still going to ask these questions of everybody.
I'm muting again.
Okay. So this is what we're looking for in the current ratios. And so if you go over, and again, we're going to use tables 3.1 and 3.2 to find these numbers. And we're going to be using, for these examples, 2010. So to find current assets, you go down here on the balance sheet, and you got to go down to total current assets. It's 810. In this case, it's 810 million, but you really only need to use the 810 as long as you do everything in millions of dollars, right? If you keep everything in that same denomination, then you can use simple numbers and you don't have to type in $810 million. So we're going to take current assets, which is 810, and divide it by current liabilities. So you go down here and you got total current liabilities of 220. So the math here is just going to be, whoops, let's see if I can do this. So 2010, it's going to be 810 divided by, what did I say, 220? 220. And this is going to be the current ratio, the calculation for the current ratio. So I'm going to go ahead and do that here quickly on my phone. And you can, and if you guys would double check my math here, I'd appreciate that too, since I am doing it on my phone. It's not always the most accurate way to do it. 810 divided by 220. So I get 3.68 as my current ratio. So one thing about all of these calculations that we do from here on out, everything that you should be doing should go to 2 decimal places, to the hundredths. So don't give me 3.6 or round up to 3.7. The answer I got here on my calculator was something like that. So I just round to the hundredths. So it should be 3.68. And what this means is that the company has roughly 3.68 times as many assets as it has current liabilities, which means that in the next year, they should have a pretty easy time of paying their bills, of paying their liabilities, because they have almost 4 times as many assets as they will have bills coming due in the next year. So this is what the current ratio is really is trying to give you an indication of, is how able is a company going to be to pay its bills in the next year. Because again, current assets and current liabilities just have to do with this next 12 months. So this company is in pretty good shape. If this ratio, if this were backwards and they had, say, 220 million in assets, current assets, and 810 million in current liabilities, and the ratio would work out to be like 0.25 or something like that, less than that, that company's in pretty bad shape, because that means it doesn't even have as many current assets as it needs to pay off its current liabilities in the next 12 months. So this ratio, current ratio, basically you always want to be greater than 1. A higher number is better. But if it's at least 1, that means that the company has as many assets in the next 12 months as it will need to pay all of its bills in the next 12 months. So that's what current ratio tells us here. So what I want you guys to do now is to do the same calculation for 2011 based on the numbers in table 3-1. And I'm going to do it here, and then we'll see what you get. So 2011. And whenever somebody gets an answer, go ahead and let me know, and we'll check.
Is it 3.22?
3.22. You're fast. Let me let me check. I didn't even get there yet. Actually it's 3.23.
Oh,
You
I didn't round it.
Yeah, you want to round up. Whenever it's 5 or above, you want to round up. But yes, it's 3.23. So what numbers did you use to get that, Marcus?
I did the current assets 1,000 divided by the current liabilities of, what was that? 310.
310, right. Yep. So 1,000 divided by 310 gives you 3.23. So 310. So that's how you figure out current ratio. It's pretty straightforward. Again, you're going to have, I'm going to provide you with a balance sheet and an income statement for these ratios in both your assignment and the test next week. And so you're going to simply be looking for current assets and current liabilities if I'm asking you for current ratio. Okay. And I will, what I will do is when we're done with class tonight, I will post this to Canvas so you guys can have sort of notes and references to how to calculate these, what we did tonight, which hopefully will help both your assignment and your test performance next week. So, all right. So any questions about current ratio before we move on? No? All right. Quick ratio is really similar to current ratio with one difference. Quick ratio removes inventories from the current asset in the numerator here. And the reason they do that is because inventories tend to be, of all the current assets, they tend to be the things that are the most time intensive to turn back into money. So it takes the longest to turn an inventory into money. It takes it much longer, obviously, than accounts receivable, which are payments that are due to the business already. And certainly cash is the most liquid asset because it's already cash. So for this calculation, you take current assets and you subtract out inventories. And you have to do this first. You have to do that calculation, and then you divide by current liabilities. Okay. So you see these equations are pretty similar, with the exception that we're taking inventories out of the top here. So for the example of 2010 here, the calculation will be, so we're going to take our current assets of 810, and we subtract out our inventories, which are 415. So the first part, the numerator of this is 810 minus 415. And like I said, you have to calculate that first. And that turns out to be 395. So then you take that and you divide it by current liabilities. And since I've already done that and it didn't change, I know there are 220 here. I'm going to do this on the computer. It's easier. And so this becomes my calculation for the quick ratio. So 395 divided by 220 gives me a quick ratio of 1.795, which rounded up would be 1.80. So again, I could report this as 1.8, but I'm going to ask you to provide all of your answers here to 2 decimal places, so just remember that. So the quick ratio for 2010 was 1.80. So can you guys go ahead and calculate the quick ratio for 2011 using that same formula? And I'm going to ask anybody else from Marcus to tell me what the answer is, since you went first. Let's see. Oops.
I got 1.24.
Excellent. I'm sorry, who was that?
Helen,
Helen. Thank you, Helen. Yeah, 1.24. So for this, that's what I got to. So I'm assuming it's correct. We took 1,000 and we subtracted out again the inventories, and that was 615. So that left us with 385 divided by, and again, we already have this current liabilities number from our previous calculation, 310, which gives us 1.24. So that's a quick ratio. So in 2010 or 2011, which year were they doing better as far as the quick ratio goes? If you're just comparing the 2 years, anybody can answer.
2010.
2010, yes, exactly. Just like the current ratio, the higher the number, the better, because it just tells you that you have more assets compared to your more current assets compared to your current liabilities. And so in 2010, they were doing better with their quick ratio, and not surprisingly, in 2010, they were also doing better with their current ratio. Those would typically trend the same way. Okay, so that's current ratio, quick ratio. Any questions about either of those two? Okay. All right, so let's move on. The next few ratios, the next two, I guess, again, inventory turnover ratio and days sales outstanding, they're sort of classified as asset management ratios. And the reason that they're called that or classified that is because these attempt to show how well a company is using its assets. In the case of number 3, inventory turnover ratio, it shows you how well a company is using its inventory. And in the case of 4, days sales outstanding, it actually tells you how well a company is doing at collecting their accounts receivable, or how much accounts receivable are outstanding compared to their total sales. So both of these are measures of how well a company is using these two assets here. So the inventory turnover ratio, the calculation for this is very straightforward. It's just, I want to do that, net sales, and I'll talk about that in a second. Net sales divided by inventories. I'll just say inventory. So we know where we get inventory already. It's in the balance sheet. Where are we going to get sales or net sales from? What financial statement does that come from?
Comes from the cash flow statement, doesn't it?
It may be, actually, maybe on the cash. It is on the cash flow statement. Well, I don't know. I don't think net. I don't have my book in front of me. I don't believe this particular net sales is necessarily on the cash flow statement. It should be, however, definitely on the income statement. That's what any income statement starts out with, is sales or net sales. And so just a note about the difference between the term sales and the term net sales. Sometimes on income statements, they will give you both of these. And so the question might be, well, which one do I use for my calculations when they ask me for sales in these ratios? And my answer is always use net sales. And the reason why is because sales is everything a company has sold throughout the year, even if it's returned at some point during the year, or even if it's discounted during the year. Whereas net sales takes out any items that have been returned or any discounts that are made on sales. And so net sales is a more precise or more accurate measure of what a company actually sold, because it's removing the items that actually had to give money back to the customers or have to give the customers a discount on. So if you ever have the opportunity to pick between sales and net sales for these calculations, always go with net sales. If it's just sales that they're giving you in an income statement, then roll with that. But for the most part, or in all cases, if you are have the opportunity to use net sales, always choose net sales because it's more accurate. So, all right, so back to this inventory ratio, net sales divided by inventory. So in 2010, on this particular income statement here, it says net sales is that right? Yes, sorry. Net sales is, again, this is in millions of dollars. So this would actually be $2,850,000,000 in net sales. Again, if we keep everything in the millions of dollars, we don't have to put all the zeros behind this. So I'm just going to put 2,850 divided by inventory. So we have to go back to the balance sheet to find the inventory. And in 2010, our inventories were 415. So the math here is 2,850 divided by 415. So my inventory turnover ratio, 6.867 or 6.87 would be the inventory turnover ratio. And what this means, what this number means, is that they've essentially sold through their average inventory, or the inventory on their balance sheet at the end of the year, almost 7 times. So they've sold through their inventory 7 times. They've had to put out their inventory 7 times, and it's been sold through. This number, just like numbers 1 and 2, you want to be as high as possible. That means that the company is carrying a lower level of inventory relative to sales. It means they're really pumping through their inventory. They're selling it out quickly, and that's a good sign. If they have a lot of inventory that sits, if this number is low, if it's maybe like 1 or 2, that means that they're barely selling through their inventory in 1 year, and that tends to mean they probably have some stale products that they're going to have to write off. It also means that they just have a lot of money locked up in inventory compared to what they're selling. And so the smaller the inventory, as long as you're not missing out on sales because you can't provide the products, the smaller the inventory, the better relative to sales. So you guys do 2011, and someone else besides Helen and Marcus tell me what the answer to this one is. Oops.
4.88.
All right, just a second. You're going to have to give me a second to calculate it. Okay. Who was that, by the way?
Jessica.
Jessica, thank you. Yes, it would be 4.878, or rounded up 4.88. And we essentially are taking $3 billion in net sales and dividing by the inventory in 2011 of 615, and that gives us 4.88. So it looks so far, for the first 3 calculations, it looks like 2010 from a financial performance perspective was much better for, what is this, Allied Food Products than 2011 was. They sold through their inventory faster. Their quick ratio and their current ratio were better. Things seem to have slowed down in 2011 for them. Even though they sold more product, they're carrying a higher level of inventory, which is why this number is lower than 3. All right. Any questions about that before we head on to days sales? Okay. So this one's day sales outstanding. Again, it's sort of a performance measure of how well the company is using their accounts receivable. And the way that you calculate this is you take accounts receivable, so that's what we're trying to judge here. Let me just start using AR because I hate typing that out. Whenever I say AR, you should know accounts receivable. AP is accounts payable. So you take your AR number and you divide that by, and you have to do this calculation first. Sales, I'm going to be more specific here, net sales divided by 365. And so what this calculation is doing here, the bottom part, net sales divided by 365, is telling you what the amount of sales on average per day is based on the year-end financials. So this will give you amount of net sales per day. And then when you divide that into accounts receivable, it will tell you how many days of sales you're actually carrying as accounts receivable. So, and the more days that you're carrying as accounts receivable, the less well you are using your accounts receivable account, because it essentially means you're not collecting on those debts as quickly as you would like. Ideally, you'd like everybody to purchase with cash for all sorts of reasons. One, because you have cash right away. But if you're not, and if you're extending credit, then you just want to be able to collect on that credit in a timely fashion. And so if this number creeps up, that means you're not doing a great job at collecting on those receivables. So let's see here. For 2010, we go to our balance sheet and accounts receivable, and we have 315 is our accounts receivable here, 315 million. And we're going to divide that. Again, we need to take net sales, which from up here I know is 2850, divided by 365. Whoops. And that will give me the days sales outstanding. So you need to calculate this first, just an FYI. You need to figure out what your denominator is first, and then you can divide that into 315. So I'm going to quickly do that here. 2850 divided by 365, 7.808. So that means approximately 7.81 million in sales per day is my average sales per day. So 315 divided by 7.81 equals our day sales outstanding. So 0.81, 40.33. Yeah, 40.33. And this should be, for your answer, this is represented as 40.33 days. That's how many days of sales that the company has yet to collect, that they're waiting to collect from customers. The higher this number goes, the worse. You want to collect as quickly as possible. So if you can decrease your day sales outstanding, that's better. So how about 2011? Can you guys calculate 2011 day sales outstanding? Someone other than Marcus, Helen, or Jessica.
45.62.
45.62. Let's see here. Anybody else get 45.62? I haven't calculated it yet.
I
I
got
did.
45.62.
Excellent. All right. So, yeah, basically, I guess I need to share here. A second. So in this one, just like in 2010, we took from 2011 our AR, which was 375. So the accounts receivable went up, and then we divided it by 3,000 divided by 365, and got 45.26. Is that right? Or 62? Math real quick. Is that right? 45.26?
0.62.
62. Thank you. Math dyslexia. All right. So again, even though they sold more in 2011, they sold 3 billion versus 2,850,000 in 2010. Their performance in this measure is not as good as it was in 2010. In 2010, they only had 40 days sales outstanding that they needed to collect. In 2011, they're up to 45.62 days. This measure is only relevant for companies that offer credit. Any company that does not offer credit, if they just do cash sales, or even if they do cash sales and credit card sales, because businesses get reimbursed for credit card sales within 3 to 5 days, typically from the merchant, from the bank. This measure is really for businesses who do a lot of financing, and so or have to wait for their bills to be paid. This measure is used a lot in healthcare situations, in hospitals and clinics, because they deal with insurance providers a lot. And insurance companies don't have a great incentive to pay in a timely fashion. In fact, it's to their advantage to sort of delay payment to the healthcare provider, because it helps their bottom line. They're essentially not having to pay out. So in addition to trying to decrease the amount that the insurance company has to pay to the healthcare provider, they also try to, and not all insurance companies are like this, but it's financially to their benefit if they delay payment as long as possible. And so I worked at a hospital as a technology director for 3 years. And in the business office, this is like the major metric that they use to evaluate the performance of the, what do they call them, the patient collections agents. If this number was going up, if it got to, say, usually I think it was between 50 and 60 days, but if it started creeping up to 70 or 80 days, and they had 70 or 80 days worth of services that they had yet to collect on, then essentially the CFO would come down and have they would talk with these collection agents, and they'd have a push to bring this number down. So that's just one example of a type of business that's impacted by this. Any other sort of business that extends credit that doesn't have it's not a payment schedule like a vehicle or a bank, those don't really, at least for vehicle loans and home loans, this isn't really that relevant because you're on a payment schedule. But for things like credit card companies, probably to some degree use this, because this is a measure of how long it's taking their customers to pay them back from the money they've advanced them. So day sales outstanding, again, it's just a measure of how well a company is using its accounts receivable. Okay. And again, you have to just remember, you need to do this calculation first and then divide that by 375. So get up here. All right. How about if we take a break right now? We're almost at 6 o'clock. So let's take a 10-minute break. And according to my clock, it's 5:57. So we'll come back at 6:07, and we'll work through the remaining 6 ratios here. Okay.
Where's the classroom that you're at right now?
Do you know where the bookstore is?
Yeah.
It's in that bit. It's right next to that. SAC 2.
Oh, in the same building as the bookstore?
Yeah.
Okay.
Yep.
All right.
Yeah, it's a pretty good.
sounds like maybe that one would be more of a one that could actually.
Wow. Do you still have your phone on? I show you as mute, but okay. Yeah, I mean, they just have they have a ton of resources down there that they've been gathering, both the institute and their programs. I'm not sure exactly what programs they have on the bachelor's and master's level, but yeah, I'm sure they.
Just been wondering where I should try to apply for my master's, like which schools would I should. Seems like some of them know a lot more about, like travel business than others.
Mm-hmm. Yeah. There are a lot of mainstream graduate schools. So Evergreen State has a couple pretty good programs. They're not, I think they're geared towards more like public administration. They have an MPA, Master's in Public Administration, down there. And I know Gonzaga has a MBA, Master's in Business Administration program that's focused on some sort of, I can't remember what they call it, but it's basically American Indian economic development type stuff.
Yeah, I
So-
heard about that one. I think they said you can do it online too. So.
Yeah, I think
I
they
don't know. I don't do well with online though. I'd rather have like classrooms.
Yeah, it's challenging sometimes. Yeah, well, especially when you have
So,
two
like,
kids running around.
Yeah, that's why I asked my sister today because he said we were working on the problem. So I was like, asked her to babysit so I could try to, I don't know, have more attention and focus for the problems.
Yeah, it definitely helps. All right, so let's get back to these. Let's finish off these equations here. Let me share my screen again. So, been through the first four. The next couple are the debt ratio and the times interest earned ratio are called debt management ratios. And that's primarily because they're measures of how well a company uses debt and how much debt a company has, or an organization for that matter, has. And especially the debt ratio is used a lot by banks to determine, both for individuals and for companies, how much of a debt load the individual or the company already has, and thus how likely it or unlikely it would be that they would be able to repay another loan if they were to get a loan. So it's used in the loan approval process quite a bit, especially for businesses, more so for businesses than individuals. And this is pretty easy equation. It's very similar to the current ratio. It's actually sort of the opposite of the current ratio, except it involves both current and non-current liabilities and current and non-current assets. So the equation is total liabilities, which includes everything, both current and non-current, divided by your total assets. And so if we go and look at table 3.1, which is where we find these in the balance sheet, has things organized by current assets, and then it calls the long-term assets fixed assets or property, plant, and equipment. And so your total assets here are $2 billion in this case. And here in the liabilities, again, it breaks it down: total current liabilities, which we've already worked with, and long-term bonds. If you see anything in the liabilities section that says long-term, it's a non-current or long-term liability. So you add those two together, you get total debt. Debt and liabilities, those terms are used interchangeably. So whenever you see debt, think liabilities. Whenever you see liabilities, think debt. It's the same thing. And so you have total debt of $1,060,000,000. So the calculation here for 2010 Did I do that right, actually? Oh, I'm sorry. I was looking at 2011. Let me do 2010. So total assets here in 2010 are 1,680,000,000, and total debt here is 800 million. So then the calculation becomes the 800 million divided by the 680 million, and this is presented in a percentage form, and so you have to convert this calculation to percentage. So when I calculate this on my handy dandy computer calculator here, I get 0.476, and so if you round that to 2 decimal places, well, let's not do that. Let's convert it to a percentage first. So what is 0.47 as a percentage? If you converted that to a percent, what would it be? 47%. Yeah, you move the decimal place. This is a review, hopefully for all of you. Move the decimal place 2 points over, and that converts it to a percent. So you can just multiply it by 100 too and get your percent. So it's 47.619%. So because I want you to go to 2 decimal places, the answer here would be 47.62%. And what this means is that the company owes 47.62% as much as they have in assets. So basically, if the company were to sell off all its assets, it would have to pay back 47.62% of it to pay off their liabilities. And then the rest would be their equity, what they have remaining. So that's debt ratio. So go ahead and calculate that.
When they use these numbers, like, do they use like how you have us round it to 2 decimal spots? Seems like when you're working with large numbers, though, like any little bit would change it. Would they use the long? They probably use the long version of it, right, to get more accurate. Or would they?
Well, it's just a matter of it. It's a matter of presentation to some degree. I mean, at some point, it becomes what we'll say is immaterial, not relevant anymore. If it like 6 decimal places out, if it's different, that doesn't really matter that much. What they're really looking at, I mean, some people who would look at this calculation would maybe only look at the fact that it's 47%. They say it's like, okay, the debt ratio is 47 or 48%, but just
it's not like changing their numbers in their books or anything, right?
No, it's not manipulating the numbers. It's just how precise do you want to be based on what you're going to use the number for. So, and we're just going to do everything to 2 decimal places because that's a fairly common way that people calculate things. So, all right, so we're working on 2011 here. So now it's a free for all. Anybody who wants to throw out the debt ratio for 2011.
You're at 53%.
53%. Just by eyeballing that, I would say you are correct because they have total debt of $1,060,000,000, and you divide that by their total assets of $2 billion, and that should be 53% or 53. I wouldn't mark you wrong for that, but if we're going to 2 decimal places, 53.00%. So that's what I would prefer to see on in your homework assignments and on the test. So I probably wouldn't mark you wrong for that, but you could impress me and just present it that way. All right. Any questions about debt ratio? It's pretty straightforward. All right. Times interest earned. This one's a little bit different. This is also a sort of a measure of how a company uses debts. But really what this ratio will tell someone is how much a company's profits can decrease before they won't be able to make their debt payments anymore. And I'll show you why that is. So this is again, this is a measure that can be used by banks when they're, or other investors or creditors who are thinking about loaning a business money to determine if this company has a downturn, if their income goes down, to what extent, how much would it need to go down before they wouldn't be able to make their debt payments based on their current structure, their current debt structure. So, so the way that you calculate this one is you take EBIT, which is earnings before interest and taxes, and you divide that by, make sure I get this right here, interest expense. And so this is essentially showing you what your earnings are before you deduct your interest and taxes, and how much they would go down before you wouldn't be able to make your interest, or before you essentially wouldn't be able to pay the interest expense that you're paying every month. And the reason, so in this calculation, anything at 1 or below means that the company, at that point, the company would no longer be able to make their interest payments. So this is one where you want it to be as high as possible. But as it gets closer to 1, that means it's much more likely they won't be able to make their payments on their existing debt. Oh, and by the way, up here for this debt ratio, essentially the lower the better. You want fewer liabilities compared to your, fewer total liabilities compared to your total assets here. So debt ratio you want to see lower. All right, so back to times interest earned here. So our EBIT, we're going to see that on our income statement. So we go here, EBIT. And EBIT, another name for that aside from earnings before interest and taxes, is operating earnings. It's what the company makes on operations when you don't take into account their interest charges or the taxes that are levied on them. And really, from an operational standpoint, you can't control the existing interest or the tax structure that you're in. So this can be used as a measure of how well a company is operating the business. So we have EBIT of 263 million here. And then the number immediately below that is their interest expense. It's less interest here, so 60 million. So the calculation here would be 263 divided by 60. And that would be 4 point something. 263 divided by 60, 4.38. And this is not a percentage. This is just a number here. It's a ratio. So that means that they are making over 4 times as much in operating profits as they need to pay in interest. So their earnings would have to decrease by 4 times before they would start struggling paying their interest. So that's probably a pretty good ratio for them. So how about 2011? What's that going to be?
$3.23.
Yes. Yeah, 3.23, 3.225, 2 decimal places, 3.23. And that's just 283.8, I think. Is that what it was? Yeah, 283.8 divided by 88 gives you 3.23. So again, we're seeing that the company is, comparatively between years, the company is doing better in 2010 than 2011. They have a higher, even though their EBIT is higher in 2011 than 2010, their interest payments are proportionally even more, have increased even more. They've gone from 60 to 88, which is almost a 50% increase in interest expense between the years. And their EBIT certainly is not increased by 50%. So that's why that number is lower.
What would make the interest go up?
They took out more loans, Or if they had so the interest would go up if they took out more loans, or if they had some sort of adjustable rate on some of their notes, and the interest rate itself went up. All right. Any questions about that one? Times interest earned. All right. Now we're getting to the big boys here. 7, 8, 9, and 10 are the key measures that are used to determine essentially how profitable a business is based on compared to a few different facets of its operation, and we'll talk about the difference here. But first of all, return on equity, we're going to abbreviate as ROE from now on. This is how you'll see it in the real world. Not that we're not in the real world right now, but if you're in the business world. Return on assets is ROA. Actually, you hear the most typical thing you'll hear just in offhanded fashion about if you're analyzing investment is what is the ROI, and that just means return on investment. That's the equivalent, really, of looking at a project via the return on assets perspective. But I'll talk about that in a second. Return on equity is essentially how profitable you are compared with how much equity the ownership group has in it. So the owners have invested an amount of money in a business, and then the question becomes, well, based on that amount of money, how much are they earning? And so the way we calculate return on equity is net income divided by total equity. And actually, I'm not going to write that. I'm going to write how you figure out what total equity is. Total equity for a publicly traded company, if it's a private company, then you just look on the balance sheet and say, oh, there's your owner's equity. That's what the total equity is. But for a publicly traded company, there are a couple components to equity. One of them is common stock. And this is the value that the shares were first offered at, not what they're trading on at the market right now, but what they were first offered at. So the value of common stock plus retained earnings. And so, get this out of the way so I can type here. Retained earnings, actually, one second here. There we go. Retained earnings are profits that the company has earned but has not distributed back to shareholders in the form of dividends. So we talked about dividends already, and the fact that that's one way shareholders make money is when a company is profitable, they say, okay, we made $100 million this year. So we're going to take $50 million and distribute it out. For every shareholder, they get, let's say, $1 a share or something like that, whatever it works out to. They will distribute the dividend in an amount per share to all the shareholders. That's one way investors or shareholders earn money on their investment. The other way, obviously, is if the stock price goes up higher than when they bought it. So, but for a publicly traded company, this is how you calculate total equity. You add the initial common stock value plus the retained earnings, and that gives you your total equity. And that's what you need to do in this particular equation. So, in 2010, the net income of the business is 121.8. So 121.8 million is the net income, and we need to divide that by common stock and this one is common stock price. Sorry, I'm looking for this information. It's not going to be, oh. Yes, sorry. I was looking in the wrong financial statement. It's on the balance sheet. We're going to find this information. So here at the bottom of table 3.1, you have common stock at 130. That's 130 million. And if you see that there are 50 million shares that are traded now, their average initial offering price then was about $2.15 a piece on average. The retained earnings is 750 million. So you have your total common equity here of 880 million. So they've already done the math for us. Don't have to do that. So you take 121 divided by 880, and this is an equation that we will want to represent in as a percentage. Actually, all four, 7 through 10, are all ones that you'll want to represent as a percentage. So we come up with 0.3184 here. Turn it into a percentage, multiply by 100. So 13.84%. So that on average, for every dollar that an owner has an equity in that business, they're earning 13.84% on it. It's pretty good, especially these days. That's a pretty good return on investment. Return on equity, excuse me. So you guys do that for 2011, then calculate the return on equity. Are you calculating it?
Is it 0.125?
Yes, 0.125, which in percent is what? 12.5%, yes. So the answer for that one is 12.5%. What were the numbers there again? I'm sorry, I think it's 117.5 divided by 940, is that right? 12.50% again. We'll take it to 2 decimal places. So that's return on equity in 2011. Like all of our other indicators so far, it looks like 2010 they did a better job of running the business. So that's 12.5%. So this is net income compared to equity. The next one, return on assets, we're going to compare net income to total assets. And so this includes, excuse me, both the equity that the owners have and all the stuff they don't own, essentially all the things they have loans for. So net income divided by total assets. So again, in 2010, our net income is 121.8, and then we go to our balance sheet and find total assets, not total current assets, total assets here of $1,680,000,000. So we divide that into there, and 0.8 divided by 1680 is 0.0725 or 7.250% is the return on assets. In almost every case, in every real world case, your return on assets will always be lower than your return on equity, because if the company has any loans out there, that's going to add additional assets on top of what the ownership equity is, and so that means this equation, this number below, will be bigger than the equity number. Their total assets will be larger than the equity if they have any loans in the business. So this, you can typically always assume that return on assets will be lower than return on equity. All right, how about for 2011?
Are we still rounding up? Right.
Yes.
So 5.88%?
You got it. 5.88%. And that's just taking this 117.5 and let me scroll up and dividing by 2 million or 2 billion, excuse me, and you get 5.88%. I don't know why I did that. Sorry. All right. So again, 2011 not performing as well as 2010. All right. So that's return on equity, return on assets. Any questions about those two? Again, the math on these isn't tremendously complex at all. You obviously need to know what the ratio is comparing, but you also need to know what it's telling you. And so that's just be aware of that. All right, operating margin. So these are the last two ratios, and these are also profitability ratios, but they measure things a little bit differently. They measure profitability compared to sales, not compared to equity or compared to assets. So operating margin takes, takes your EBIT, earnings before interest and taxes, and compares it to sales. And I'm going to put net sales here again because if you're given that amount, you always want to use net sales. And so for Allied Food Products, we have net sales in 2010 of $2,850,000,000. And we're going to divide that by net. Whoops, I did that backwards. Sorry. There's my sales. And then we need EBIT, earnings before interest and taxes. So we go up here, 263 million. So we're going to take, and just like 7 and 8, this is going to be reported as a percentage. 260, did I say 3? Yeah. 263. So our operating margin in 2010 is going to be a little less than 10%. 50. 9.22, 9.23 rounded up percent was the operating margin. So the way to think about this one is they earned from an operating, just from operations without taking into account taxes or interest, they earned 9.23 cents for every dollar that they sold. 9.23% of every dollar that was sold came back as operating profit for the company. So again, this is comparing profitability with sales. So how about for 2011? What is their operating margin there? Interesting.
It'd be 9.46%.
Yes, exactly. 9.46%. So 283.8 was their EBIT, and 3 billion was their sales. gives you 9.46%. So this is interesting. This is the first measure from this business that improved from 2010 to 2011. Does anybody have any ideas why that might be? That operating margin so far is the only thing they've done better in 2011 than 2010. Wild guesses are totally appropriate. No. Well, my guess, since no one else is going to guess, my guess is that it is because in 2011 they took on a lot more debt, and so they had a lot more interest expense, which is not taken into account here in the earnings before interest and taxes. The tax rate stayed the same between the 2 years, so that didn't change. But the interest did. The interest, I think, went from like 60 to 88, if I recall correctly. Yeah, it went from, so they have 88 million in interest expense in 2011 and 60 million in 2010. And since this particular equation does not take into account interest, they actually did a little bit better with their operating margin in 2011 and 2010. However, I'm going to guess that their profit margin, which is the next thing we're going to calculate, they didn't do as well because the profit margin does take into account interest. And the equation here for profit margin is very similar to operating margin, but instead of EBIT, earnings before interest and taxes, we're dividing by net income. So it's net income divided by net sales. And so net income takes into account everything, all of your expenses, depreciation, interest, and taxes. This is your net income is your bottom line. And so in 2010, let's see here, net income was 121.8. I know that from the return on equity. And net sales, again in 2010, from right up here, is $2,850,000,000. So that will be 121.8 divided by 2850. Oops. 0.0427 times 100 gives me a percent, which is 4.273 or 4.27% in profit margin in 2010. So how about 2011? Somebody crank that number for me. As you work your way down these ratios, and this is the same form you're going to be using to calculate all of your assignments this quarter, it gets easier because you've already found, say, net income or net sales in previous numbers, and so you don't even have to look at the financial statements if you remember where they're from.
Is the answer 3.92?
The answer is 3.92, yes, because their net income in 2011 was 117.5, which is less by about 4.3 billion or million than 2010, but their sales is actually more, 3 billion. So that gives them a 3.92% profit margin. So that means of all the sales that they made, for every dollar that they sold, they actually, after all expenses were taken out, including interest and taxes, they walked away with 3.92 cents, 3.92% of all sales. So, and again, you see in 2011, they didn't do as well as 2010, and I would hypothesize that that was because of that added extra interest expense, primarily in 2011, that they're not as, their profit margin isn't as high, but their operating margin was.
So when you say that, like, it seems like they didn't run their business as well in 2011. It's like, you know, looking at it, you might be able to be like, well, they made the wrong investments, or they took out too many interest loans.
They took out more, yeah. So just as a way to think about this, these are 10 different ways or 10 different perspectives to look at the performance of a company. And if you're working for the company, a lot of times what you'll do is you will compare your current year results with prior year results to see how you're doing compared to historically how you were doing. And so in this case, if the management did that, they would say, wow, we're not doing as well in these areas. And they would try to use, or if I were them, I would try to use the financial statements and some of these ratios to figure out why I'm not performing as well as in previous years. And again, one of the big indicators for me here is that their operating margin is the only measure of performance that's higher in 2011 and 2010. And that removes the effect of interest and taxes. And if taxes stayed the same, then interest has to be one of the causes of the added interest expense has to be one of the causes of their not performing as well in 2011. So
that's mainly like loans, you think?
Yeah.
Taking out loans.
Yep. Loans or bonds, if they sold bonds. Yeah.
So are all these ratios, are these all in chapter 3?
No, these are all in chapter 4.
Oh, all
Yeah.
in chapter 4,
Yeah.
and these are like the top, I don't know, like standard 10 or something that
Yeah.
you use, or what is?
These are my top 10. Yeah. If I had a top 10 list of financial ratios and I was on the David Letterman show, I would give him these. I would say, these are my top 10 financial ratios. There are plenty of other ratios in chapter 4, but these are the ones that we're going to be working on in this class. So, all right, so those are all the ratios. Any questions about any of that stuff? Anything we've talked about? Well,
So we're going to be using the same guides that we've been looking at throughout the whole thing?
the same what?
The same, like, you know, whose ever balance sheet and whatever we've been looking at? Allied food products?
Well, so I just used Allied Food Products as an example because they had this side-by-side comparison and it's convenient. But if you go to week 5 in Canvas, I'll move everybody's picture again, and talk about the assignments here real briefly. You have this financial calculations worksheet here. That's what we've been working on, and that's what you use for these calculations to turn in your calculations. But what I'll provide you, if you click on under assignments, there's a downloadable form called Hagen's Financial Statements. This is probably not a great example given the state of Hagen's these days, but I did this before they were bought out and summarily destroyed by Albertsons. So what you have here is an Excel spreadsheet with 2 tabs, and on one tab is the balance sheet, and on a second tab is the income statement. And so again, these are all of the numbers that you would need to calculate any of those ratios, any of those 10 ratios. And so this is how I'll present it to you in assignments. And you know, I'll use different businesses, and obviously the numbers will change up between the businesses, but you'll get a balance sheet and an income statement, and then I'll ask you, you know, to provide answers to certain ratios. And if you'll notice here on the income statement for Hagen's, at the top, they have operating revenues, they have sales, and then they have net sales. So which one of those are you going to use?
Net sales?
Net sales, yeah. Always use net sales.
So where did Hagen go wrong?
Where did Hagen go wrong?
Too many loans or what?
Hagen, in my opinion, Hagen went wrong because they tried to expand they bit off way more than they could chew. I mean, they were trying to expand from 18 stores to like 160 stores. So they were trying to grow to be 10 times their size, and it just, I honestly think that Albertsons set them up for failure, but that's just my opinion. All right, so that's how the financial statements will be presented for these types of calculations. And so for next week, really, there are 2 assignments, both from chapter 4. There's doing these Hagen financial statements. And so, again, use this financial calculations worksheet, which has those 10 different ratios on there to provide answers based on the Hagen's financial statements. And then this one question from Chapter 4, question 411, which I also have as a downloadable question. But I just want to briefly explain this here so that everybody knows what to do for this. So this is, make it bigger. This is 411, and I think I'm just asking you to do A through I want to say. Does it tell me? It doesn't. It will tell you on Canvas. But what you need to do for each of these is to determine whether or not these are all things that can happen or actions that a company can take. And the first one is cash acquired through issuance of additional common stock. In other words, they sold common stock. So then what you need to do is determine for total current assets, the current ratio, and net income, what effect would that have on them? It would either increase them, so you'd put a plus in there, decrease them, you'd put a minus, or if it has no effect or you can't tell what effect it would have on that particular ratio or class of account, then you would just put a 0 in there. So for each of these actions, you need to put something in all 3 boxes. It's not like pick one. You have to decide. So for A, I'll just go through this as an example. They issued stock and got cash through that. How is that going to impact current assets? Is it going to increase it, decrease it, or have no effect? Increase. It will increase it. They will get cash and they will give stock away. They will give part of the business away. How about the current ratio? What impact would that have on the current ratio? And again, the current ratio is current assets divided by current liabilities. Anybody have an idea what that would do to current ratio? It would go up also because they're getting more cash, so their current assets are going up, but their current liabilities aren't going up because they're issuing stock. That's not a liability, it's just a part of the business. And so their current liabilities would stay the same, but their current assets would go up, so the ratio would go up. And then the effect on net income, what would the effect on net income for this be? Positive, negative, or no impact? Or we have one positive. That's not right. Anybody else? We got 2 other choices.
Oh, positive, not right.
Positive's incorrect.
Oh.
Correct. It's positively incorrect. It would have no, potentially it would have no impact because you're simply selling stock. It's not an operation of the business where you're selling like your product or your service. You're just selling additional stock. You're selling part of the business away and getting cash for it. It won't have an effect, a direct effect on net income at all. So that would be 0. So you'd have plus, plus, 0. And so you just go through each of these, and I think it's A through I want to say I assigned. Let's see here. A through I only, yes. So you just have to do A through I on that. So the 2 assignments for next week are Hagen financial statements, those 10 financial calculations, Chapter 4 question, and then any other homework that you haven't turned in yet, you need to turn in by 5 o'clock next Tuesday when we start the test or shortly thereafter, if you want credit for that. And just also, as I said before, make sure to sort of organize your notes and organize information about these calculations because you'll have to use them for the test next week. And the in-class portion will end at 7 o'clock. And so you just want to make sure you have all that stuff together and ready to go. So for next week. All right. I think that's all I have. Anybody else have any questions, comments? Aside from you want to get outside and enjoy the sun before it goes down.
Is that that worksheet that we just did? Is that going to be posted somewhere on Canvas?
The examples that we just did?
Yeah.
Yeah, I will. In fact, I'll do that right now. I'll just post it in week 5, and it will be, I'll label it in-class examples. So I'll do that right now. So
Okay.
in class. Okay. Any other questions? All right. If not, I will see you next Tuesday for the test. Please be there for the test. It's very challenging if you're not there to work through things. And if you have any questions this week on homework or any of these, especially any of these ratios that we worked on tonight, email me and we can set up a time to either Zoom or just I can try to answer any questions that you might have. Or you can come see me in person or call me too. But email is usually the best way to initiate conversation with me. All right.
Okay, I had a quick question before we logged off about the test or whatever. I just logged in earlier today and it was glitching a lot. So you're saying don't use Internet Explorer. Make sure to download Firefox or Chrome.
Yeah, use anything but Internet Explorer. That's what they NNI recommends, not to use Internet Explorer. It's something to do with the plugins. I don't really understand it, but yeah. So Firefox, Google Chrome works as far as I know. I don't know what Apple's browser is called these days, but yeah, anything else I've heard works well. And yeah, if for some reason that doesn't work, and I'm going to email you that her suggestion, check to make sure that you have the most recent version of Adobe Flash is the video thing. So,
all right. Thanks, Steve.
all right. Have a good week.
You too.